James P. O'Shaughnessy, What Works on Wall Street, A Guide to the Best Performing Investment Strategies of All Time. Embark on an insightful journey through the world of stock investments with James P. O'Shaughnessy's What Works on Wall Street, A Guide to the Best Performing Investment Strategies of All Time. This summary outlines how passive investment strategies consistently outperform active management, the important role human emotions play in determining stock prices, and the rigors of following a well-defined investment model. Delve into the comparison of various investment factors such as PE ratios, price-to-book ratios, and dividend yields over 45 years, and discover the effectiveness of multi-factor modeling to increase returns. Unveil the secrets to make money in investments by ignoring the emotional allure of glamorous stocks and following consistent, proven strategies.
The Power of Passive Investing. This book's summary debunks the myth that actively managing your money is the best way to beat the stock market. Instead, it recommends the simple yet effective strategy of passive investing. Investing in companies based on traditional value measures can provide significant returns. Combining these measures with strong price appreciation yields even better results. The price of a stock is determined by people, and as long as fear, greed, hope, and ignorance continue to cloud their judgment, stocks will continue to be mispriced. The book notes that stock investors can either be passive or active. Passive investors rely on index funds that represent the market. Active investors try to beat the market by picking stocks. However, active investors rarely beat the market as few manage to outpace the index. The book suggests that index funds are a better option and have gained tremendous popularity in recent years. Index funds have grown from $10 billion in 1980 to $250 billion in 1990. The book concludes that even though stock market investments come with risks, passive investing is a proven and less risky strategy that consistently delivers significant returns. The human factor in investing. The failure of active investing is rooted in human emotions. Investors are prone to unreliable patterns and fall prey to sexy stories and second-guessing. An investment model should have explicit, reliable, public, and objective guidelines, as well as credible data. Traditional, actively managed funds usually don't beat the S&P 500. Successful investing requires the discipline to follow a strategy consistently. Over 45 years, small and market leader stocks outperformed the market, while high-priced stocks got punished. Microcap stocks should be excluded from market models. Winning strategies for stock investing. The success of stock investments can be measured by different ratios such as PE, price-to-book, price-to-cash flow, price-to-sales, and dividend yields. During a 45-year period, low PE and price-to-sales ratios outperformed all stocks, while stocks with high ratios underperformed. Low price-to-book and price-to-cash flow ratios are ideal for safe and profitable investments. Large stocks also tend to be less risky than smaller ones. High dividend yields only outperform the market when investing in large stocks, while including utility stocks is not advisable. Investing in the stock market could be mystifying and sometimes tricky. To have a good return on investment, you need knowledge, patience, and a reasonable strategy to help you trade successfully. This summary presents different ways of measuring your investment success, using ratios such as PE, price-to-book, price-to-cash flow, price-to-sales, and dividend yields. During a 45-year period, stocks with low PE ratios performed better than those with higher ratios. The 50 large companies with the lowest PE ratios have shown an average annual growth of 14.1%, while the 50 companies with the highest ratios only had 9.35%. Moreover, low price-to-sales ratio stocks have grown spectacularly, with large stocks showing growth of up to $3.9 million in 45 years, in comparison to the market's $2.7 million. Conversely, high price-to-sales ratio stocks only increased to $92,000. Another measure is the price-to-book ratio, which results from dividing the stock's current price by its book value. Low price-to-book ratio stocks are a safe option, having grown to $5.5 million in a 45-year period if investing in the 50 lowest ratio stocks. While large stocks with low price-to-book ratios outperformed all stocks, high price-to-book ratio stocks underperformed, growing to $2.7 million. Low price-to-cash flow ratios are another good option for safe and profitable investing. After 45 years, investing $10,000 in stocks with low ratios yielded $4.5 million, while stocks with high ratios only grew to $335,000. Large stocks with high ratios grew to $719,000. Finally, high dividend yields only outperform the market when investing in large stocks, while including utility stocks is not advisable. Excluding utility stocks, an investment in all stocks with high dividend yields underperformed the market, growing to $1.6 million. Large stocks with high dividend yields outperformed the market, increasing to $2.9 million. In general, investing in large stocks appears to be the way to go since they tend to be less risky than smaller ones. The key takeaway is that there are various methods for investing in the stock market. Choosing one that matches your investment goals and sticking to it is the most effective way to yield a higher return on investment. 5 strategies for investing in stocks. Investing in stocks requires a comprehensive understanding of what works and what doesn't. This book debunks the myth that a stock's short-term earnings growth guarantees future success through a comparison of 5 different strategies for investing in stocks. These strategies are evaluated using real historical data over a 45-year period to determine the best approaches for making money in the stock market. The findings indicate that buying stocks based on their 1-year or 5-year earnings per share growth or net profit margin underperformed in the market. Additionally, buying stocks based on their relative price strength can be profitable, but it is quite risky. The book concludes that the best approach is to invest in high ROE stocks, even though these stocks are riskier than all stocks. Overall, this book provides an insightful and informative guide for investors looking to navigate the stock market with confidence and success. Multi-factor modeling for higher returns. Investors seeking to maximize their returns can consider combining value and growth measures by using multi-factor modeling. This approach can be especially profitable for small stocks, with a 45-year investment of $10,000 yielding as much as $22.7 million. By investing in stocks with the best price growth the previous year and P/E ratios below 20, or the highest relative price strength amongst stocks with price-to-sales ratios below 1, investors can increase their returns significantly. Large stocks, on the other hand, yield smaller returns using the same models, with up to $5.8 million for P/E ratios below 20 and $5.2 million for price-to-sales ratios below 1. Ranking investment strategies. Discover the top-performing investment strategies based on a ranking system that evaluated 66 different methods from 1954 to 1996. The best strategy includes a price-to-sales ratio less than 1 and high relative strength, earning $13 million. The second best approach involves earnings yield higher than 5 and high relative strength, earning $12.6 million. Even the 47th ranked strategy grew to $1.6 million, outshining the S&P's 500 at $972,000. Conversely, avoid high price-to-sales ratios and low relative strength, as they rank 65th and 66th, earning $64,000 and $30,000, respectively. Winning investment strategies. The key to making money through investment is by adopting tested and trusted strategies instead of emotions. Investment in stocks with great stories is risky. Strategies that have worked over 25 years should be emphasized. Consistency is essential, even when the strategy is mediocre. Risky strategies should be avoided, and diversification of investment among growth and value approaches is advisable. Combining multi-factor models, including quantitative metrics, outperforms single-factor strategies.
In conclusion, What Works on Wall Street emphasizes the power of passive investment strategies over active ones, as well as the effectiveness of multi-factor modeling. Important takeaways include the pitfalls of letting emotions cloud investment decisions and the need for consistency in following established strategies. With a comprehensive study spanning 45 years, O'Shaughnessy's observations remain valuable to investors looking to outperform the market by employing time-tested methods. By adhering to strategies supported by long-term data, investors can better navigate the oft-treacherous, fluctuating world of stocks, ultimately reaping the rewards of informed and disciplined investment.